In this segment, we're going to look at the purpose of a flexible budget. Budgets are typically used for planning purposes, but that's not the only reason. Budgets are also used for controlling. By comparing our actual results with the budget, we can analyze differences between actuals and budgeted revenues and expenses. It helps us identify areas that things are going wrong and take corrective actions, or identify areas where things are going really well and learn from what we're doing well and continue doing them. And we can take these lessons learned from the analysis, the controlling aspect of budgeting, and prepare new objectives and revise our budget for the next period. If we were to look at a performance report, in other words, comparing our actual results to a budget for ABC for the month ended January 31st of 2019, we would see that their budget was based on anticipated sales of 10,000 units, resulting in revenues and expenses and a net income of $12,000. However, they actually, for the month ended January 31, earned or sold 12,000 units, earning revenues, incurring expenses, resulting in an income of $25,400. If we were to prepare a performance report comparing actual results to our budget, we would see that the dollar amount of variance, or the difference in revenues between actuals and budget, was $25,000. And that's favorable because we would like to see our actual revenues greater than our budgeted revenues. Then we go down here and look at our expenses. Cost of goods sold. Our actual cost of inventory sold was $58,100. Our budget says it should have been $49,000. Our actual expenses were higher than our budget, $9,100 higher, which is unfavorable because we would prefer not to see higher expenses than what we had budgeted. But when we start to ask these questions, we wonder, well, if unit sales were higher than we had budgeted, shouldn't the costs be higher? And how much of these higher costs are because our higher unit sales? Or how much of these costs are caused by the fact that our cost per unit was higher? Using a fixed budget, or the originally prepared budget that was prepared based on a level of sales or a level of activity different from what our actual results were, can lead to misleading variance analysis. Thus, flexible budgets come into play. Flexible budgets take the budget and flex it. In other words, they show revenues and expenses that should have incurred at the actual level of activity. So instead of a budget based on 10,000 units sold, we would prepare a flexible budget for 12,000 units sold. That way, comparing actual results and a budget, both based on 12,000 units of sales, we'd be comparing these same things. We can prepare a flexible budget for any activity level, any sales level. This will reveal variances that are due to good cost control or variances due to a lack of cost control, and it helps us improve performance evaluation.